The slight dip is helping to lift sentiment across broader markets. Rising yields had kept stocks under pressure this week. Yields are still up significantly the past couple months with the election. Some more Fed speak about, or I should say another Fed meeting just around the corner. Here to discuss what's driving these yields off the lows, Meghan Shue is head of investment strategy and portfolio construction at Wilmington Trust and a CNBC contributor. Meghan, it's good to see you. What's this telling us, do you think?
Well, I think the big story of the past few weeks has been the move in yields and increased volatility in the Treasury markets and interest rate markets specifically. We've seen that move in yields be a result of both higher inflation expectations, but also higher real yields. So a little bit of maybe more angst around the inflation outlook being reflected in the market, but also just better economic data, which suggests, again, that real yields should be higher, getting some of the Fed activity in 2025 priced out. I actually think this creates a really good setup for equities in 2025. If you're looking at stronger data, we actually don't buy into the increased inflation angst because we're seeing virtually no signs of inflation reaccelerating. So better data, a Fed that can remain on track with maybe more managed expectations from the market around Fed activity is a really good backdrop as we move into the new year.
All right, fair enough. You know, we're sitting here with someone whose stock is up 50%.
That's why I'm smiling.
That's why you're smiling. I mean, and Ron, a lot of people have been looking at the performance of investment banks and certain parts of the financial sector as big beneficiaries of what would you describe this cocktail that has things looking so much brighter now than it did 9 months ago?
Well, for financials?
I mean, from where you sit, what's changed so much for the better?
Well, look, I think that, first of all, I think the market here is fairly, if not highly valued. So I don't know if I'm taking the other side of this. The market's at 23 times earnings. Credit spreads are as tight as we've seen in 15 years.
Right.
So I just feel
can it get any better?
Well, can it get any better? And it's going to depend on earnings. You see a lot of the stocks that will react to earnings and big misses. What I personally think, I agree that real yields in a soft landing or a no landing need to be about 1%. And if inflation, I think core CPI lands about 2.8 to 3. That means Fed funds needs to be 4. And at 4%, to me, if that's normalized, well, then the 10-year should be closer to 5. And that doesn't support a 23 times PE. So I think you have to be a little cautious in this market.
But people are arguing, I don't know if you've heard that, you know, not just today, but in recent weeks, that equities could support 5% yields, whether it was early 2000s, late 1990s, you know, that shouldn't itself be so much of a headwind.
Well, the economy can certainly support that. Whether or not we support 24 times earnings with a 5% alternative 10-year, that's another question. I don't think that math adds up for me, but, you know, hey, look, we love good markets. We're doing great. We're hitting an all-time high today.
Wow.
So I'm going to double smile.
And we should say you booked this before. It was not like you booked it this morning.
Meghan, I want to turn back to you because the long-term yields question has been one that's at least being debated right now, whether or not it is the inflation side of the story that is perhaps driving more of that narrative on the longer end side of things, like the 10-year, or is it this idea that there could actually be growth over the longer term, and that's the reason why you're seeing a bit of pressure on that long end of the yield curve? It may not be all that bad to see yields rise on the long end if it's for the right reasons.
Absolutely. That is critical. And if yields are moving for the right reasons, it's a good backdrop for stocks. I think if you looked back at the September lows, we were looking at a market that, at least on the bond side of things, was pricing in a more material risk of recession than we were seeing in the equity market. And I think we've priced a lot of that out at this point. So I agree with Ron. We've set up in terms of a market that has a lot of good news baked in. But if we do not see recession on the horizon, we have the Fed. We're actually maybe expecting the Fed to cut a little bit more than I heard mentioned just a few minutes ago. We think that the Fed can get back to a neutral rate of about 3% next year. I think that is where you get a better backdrop. But certainly some of the market is looking at higher inflation expectations, maybe some repricing of election risk. But at the end of the day, if you were pricing in a 3.6, we thought that was too low. Maybe we've overshot a little bit at 4.25, and we're probably settling in here at about 4.1, 4.2 on our expectation for the 10-year going out over the next 12 months.